Contamos también con la presencia de Arnaud Mounier, el jefe de Desarrollo de Negocios de Renta Fija en AllianceBernstein. Good afternoon, Arnaud.
Good afternoon. How are you?
It's a pleasure for us to have you today with us in Negocios Televisión. I wanted to ask you, last week we saw Fitch downgrading in France's rating from AA- to A+. How did this fixed income market digest this news?
Well, the truth is it was very well accepted and expected and priced by the market. It did not really come as a bad surprise. So now France is borrowing at yields that are 80 basis points higher than Germany. But I would note that it is about the same level of difference in yield that we were observing at the beginning of this year. So there is not a real deterioration around the sentiment about French obligation. But clearly, investors are more, I would say, comfortable with Italian bonds and Spanish bonds at this stage. On the positive side, it means that it creates opportunities for investors like us to invest maybe in French banks that have been showing quite attractive yield. On the negative side, the reality is that foreign investors in Asia and Middle East may be a bit more concerned about investing in European fixed income.
And Arnaud, as we saw yesterday, we were like all our eyes on the Federal Reserve with all this situation with Jerome Powell, this cut down in 25 basic points. I wanted to ask you, what is AllianceBernstein anticipating for the rest of the 2025?
Yes, so we saw the first rate cut for since a long time by the Fed, 25 basis points. We agree with the market that there should be 2 more rate cuts by the end of this year. So 25 in October and 25 in December. There was only one governor, the Fed, that wanted to have more rate cut, 50 basis points in September. So it's quite a consensual view. That governor is Governor Miran, who was recently appointed, and we know is very close to the Trump administration. So for the market, I think the real question at the moment is whether the Fed is going to remain independent or is it going to be driven more by the political agenda of the Trump administration. What we know, if we look at other central banks, if we look at history, is when central banks are more driven by a political agenda, then it tends to go and result into more higher inflation. And that would be obviously a concern for the market. So we do expect that interest rates in the US, especially the long end of the yield curve, is going to remain quite volatile. That's why we tell our clients maybe to favor more intermediate positioning. When they buy US Treasuries, maybe you focus on the 5-year, the 7-year, but we would rather avoid the very long end, like the 20-year and the 30-year obligation of the US.
Also, in this context, in the Federal Reserve, what are your clients investing in nowadays? And is there a strong demand for fixed income that you see?
Right. So, look, for the last 2 weeks, when we look at flows, we see 2 very noticeable, I would say, trends. The first one is really that we saw money market fund getting a lot of inflows from clients. And the second big trend was, for the last 2 weeks, outflows out of US equities. So what does it tell us is investors are probably getting a bit nervous and they want to take profit from a US equity market, which has done quite well, all things considered, since the beginning of this year. So when you see money market fund getting a lot of money, but the Fed is cutting interest rates, you would hope that there would be reasonable demand for fixed income, because what the yield you get on your cash deposit is getting lower and lower. And so we hope that investors will eventually go into fixed income funds to capture better yields, more attractive yield than what they can get in cash.
And now, with all this context, this background, with all this news that we have with the interest rate, is there a specific type of fixed income strategy that you focus on in all this environment?
Yeah, look, I think absolute level of yields are quite attractive for investors, but it's fair to say that the risk premium that you get on corporate bonds, on credit assets are quite tight, quite expensive. So it's very difficult to see a scenario where you can get very attractive return by having further tightening of this risk premium. So instead of trying to guess whether the market is going to rally a lot or not, we really focus on strategies that are playing systematically a relative value between issuers, between countries, between industries. And so at AB, we use quantitative factors to really spot those opportunities of relative value. And we think it's better to play relative value than trying to make outright bets on whether the market is going to be strong or sell off at some point.
Well, we will keep in mind all these things that you said. Thank you so much for being today with us. Arnaud Mounier, jefe de Desarrollo de Negocios de Renta, Fija en AllianceBernstein. Thank you. Have a good evening.
Thank you.